Jetzt sollten wir live sein. YouTube hat hier leichte Störungen gerade. Aber genau, jetzt sehe ich, wir sind live, wir sind drauf und wir sind noch 3 Minuten von der wichtigen Entscheidung der US-Notenbank entfernt. Und es wird äußerst spannend zu sehen sein, wie der Markt heute reagiert. Wir haben hier alles im Blick. Wir haben den Bloomberg-Livestream, wir haben hier unten den S&P 500, wir haben in der Mitte die Renditen für 10-jährige Staatsanleihen als Indikator für Inflationsängste und wir haben hier oben beispielhaft die Tesla-Aktie als sozusagen Repräsentant vieler anderer Tech- und Wachstumsunternehmen und werden sehen, wie der Markt reagiert. Vorher wollte ich vielleicht noch mal ganz kurz zusammenfassen, was der Markt eigentlich erwartet, was der Markt bereits eingepreist hat. Für viele Leute, die ja wahrscheinlich diesem Thema nicht tagtäglich folgen, das vielleicht noch mal einfach zusammenzufassen. Also im Grunde geht es darum, heute rauszufinden, ist die Fed Taube oder Adler? Also im Englischen gibt es diese Unterscheidung hawkish and dovish. Das heißt Taube oder Adler. Und da gibt es diese schöne Gegenüberstellung hier, was dann das bedeutet. Der Adler, der attackiert, der Adler greift an, der Adler ist ein starker Vogel, der die Inflation mit drastischen Maßnahmen ins Visier nimmt. Und wir sehen hier, der Adler möchte eine starke Währung, er möchte hohe Leitzinsen, er möchte, dass die Geldmenge schrumpft und das Ziel dieser Strategie ist zu sagen, die Inflation im Rahmen zu halten. Und auf der anderen Seite haben wir die Taube. Die Taube möchte eine schwächere Währung, sie möchte niedrige Leitzinsen, sie möchte, dass die Geldmenge expandiert, also wächst. Und das Ziel dieser Strategie ist eben, die Wirtschaft zu stimulieren. Und deswegen wird der Markt eben heute versuchen, zwischen den Zeilen zu lesen, um zu verstehen, ist die US-Notenbank Taube oder Adler? Und woran sie das ablesen wird, sind vor allem 2 Dinge. Es geht da um das Tapering, das sind also das ist die Reduktion von Anleihekäufen. Und dieses Tapering läuft ja bereits. Die Frage ist jetzt, wird dieses Tapering beschleunigt von beispielsweise 15 Milliarden, wie es aktuell sind, auf 30 Milliarden. Das ist das, was der Markt bereits eingepreist hat. Im Grunde die Verdoppelung der Geschwindigkeit des Taperings von 15 auf 30. Wenn wir zum Beispiel hören, dass es statt 30 nur 15 Milliarden, 15 wäre wahrscheinlich unrealistisch, weil wir gerade bei 15 schon sind, aber 20 oder 25 Milliarden am Ende rauskommen, dann wäre das eher auf Seiten der Taube sozusagen, dovish, weil das Tapering weniger stark anzieht als vom Markt eingepreist. Und das zweite Thema sind natürlich die Leitzinsen. So, wir schalten mal auf die Bloomberg-Übertragung und schauen, was der Markt zu melden hat.
The pace of the taper, going to 30 billion a month. It's going to be 20 billion in treasuries and 10 billion in mortgages as expected. They've raised their inflation forecast and dropped the word transitory in talking about inflation. Now they see PCE inflation, their headline number, at 5.3% for this year, dropping all the way to 2.6% in 2022 and 2.1% by 2024. Core PCE 4.4% this year and 2.7% next year. And yet, the dot plot shows the anticipation of 3 rate moves next year, 3 more in 2023, and almost 3 more after that in 2024. A big dispersion. Of course, you can't count on that, but they do see having to move relatively more aggressively than people might have thought. They do replace the word transitory, as I mentioned, in the statement saying about inflation. Supply and demand imbalances.
Die Seite der Fed ist gerade absolut überlastet. Ich komme aktuell nicht drauf. Müssen gleich mal schauen. Jetzt.
To elevated levels of inflation. The sectors most adversely affected by the pandemic have improved in recent months, but continue to be affected by COVID-19. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain the target range. They did not move rates today until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. So one of the questions for Jay Powell today is certainly going to be, what are those conditions that would be consistent with maximum?
Wie ihr unten seht, der S&P, der Leitindex korrigiert. Tesla mehr oder weniger gleich bei 940 US-Dollar und die Renditen für 10-jährige Staatsanleihen jetzt bei 1,47%. Und ich versuche immer noch, das Dokument zu öffnen. Es lädt einfach noch nicht. Wir hören mal, was Bloomberg hier zu sagen hat.
Fed's charting a new course going forward here. We can mention the decision unanimous.
Mike McKee, sit tight, sir. 28 minutes away from that news conference. Let's push everything Mike McKee just said through this market and begin with the bond market. The adjustment at the front end of the curve on twos yields higher by 5 or 6 basis points. We break back through 70, a destination we had reached previously about a week or so ago. That is close to the highs of the year. Back through 70 basis points on twos, up about 2 basis points on 10s to 146.50, on 30s, up by not even a single basis point. So what you have right there is a flatter curve. At the front end, as rates shift higher, what do you get in the FX market? Push it through the US dollar, a stronger US dollar. Just short of 97 at 96.88. Your equity market adjusts lower on the NASDAQ, down 117, down by about 0.8%. So, Tom, just slightly more hawkish than we expected here. Coming into this, in the dot plot, we were looking for a signal of 2 hikes next year, 3 in 2023. And, Tom, what we're seeing for 22 now is 3 then and 3 the year after.
What I do here, John, is I go to the deepest markets, and you went to DXY, that blend of our major trading partners. On TV, we're seeing that now. Radio, all you need to know is a spike up in dollar strength, buttressed up against recent highs. And then I noticed Euro didn't move all that much, maybe ECB tomorrow, but Japanese yen moved substantially, weaker Japanese yen. And John, I see an EM follow-on in Brazilian real and even Turkish lira having a struggle here. John, what it speaks to me is the power of the institution. And I want to make clear, John, this is not a parlor game. This is not about buying and selling a given stock. It's about institutional force and power, and that's what we're observing right now.
Lisa, twos adjust again. Your dollar just a touch stronger.
I can't get over this yield curve. We're seeing now the flattest 2-10s yield curve going back to the beginning of this year. When I look at the signal from this, if you still believe it gives you a signal, it is not positive. It is that the Fed is going to tighten more quickly than perhaps the economy can handle, and that it will necessarily slam the brakes on something that is going to decelerate. I find that fascinating given the dissent that we've gotten among guests on this show and on Bloomberg Surveillance in the mornings, how people just completely disagree, and yet the market has such conviction in this idea.
So as you might expect, we're trading on the dot plot. And Tom, what's going to be interesting when we get the news conference in about 25 minutes, does he choose to de-emphasize the dot plot and maybe emphasize the data dependency of any move from here on out? Tom, that's what's going to be interesting about the news conference in 25 minutes.
I like that assessment, John. I'm going to go to assessment out to 2023 to do the quick math. I believe it's 2.2 plus 2.3 is 4.5% nominal GDP. Joining us now, Diane Swank of Grant Thornton, their chief economist. Diane, this screams normality in 2023. What is your confidence we can get to normality out 18 or 20 months?
Normality is.
Ihr seht, der Markt reagiert äußerst positiv. Wir sehen eine Rallye im S&P 500. Wir sehen eine Rallye in der Tesla-Aktie. Was haben wir hier noch Schönes? Wir haben Krypto, wir haben SoFi im Plus, wir haben Apple im Plus, wir haben Mercado Libre im Plus. Schauen wir mal bei Palantir. Auch Palantir versucht hier ins Grüne durchzustoßen. Aktuell immer noch minus 0,6%. Lucid minus 0,9%. Bei Lucid ist die Bewegung etwas verhaltener als bei anderen Aktien, interessanterweise. Wir sehen Airbnb mit einer kleinen Rallye hier bei 166, 165,90 $. Wir haben Twitter, auch Twitter hier mit einer Rallye aktuell, also der Markt durch die Bank weg positiv. Und das eben, obwohl diese Ergebnisse leicht mehr in Richtung Falke als in Richtung Taube gehen. Ich habe hier nochmal die Ergebnisse der letzten Fed-Sitzung mir runtergeladen. Und hier sehen wir nämlich diesen sogenannten Dot-Plot. Das ist ja das, worauf immer alle jetzt schauen. Denn dieser Dot-Plot zeigt uns im Grunde an, wie die einzelnen Mitglieder des Komitees der Notenbank die Leitzinsen in den nächsten Jahren einschätzen. Das heißt, jedes Mitglied in diesem Komitee kann seinen Punkt dementsprechend setzen, wo dieses Mitglied die Leitzinsen in der Zukunft sieht. Und hier ist ganz interessant, da sieht man also, bei der letzten Sitzung, das war das hier, war noch ein Großteil der Mitglieder in diesem Komitee der Meinung, dass im Jahr 2022 die Leitzinsen in der aktuellen Range bleiben, da wo sie jetzt gerade sind, sich also nicht verändern. Und dann hatten wir hier 1, 2, 3, 4, 5, 6 Mitglieder, die gesagt haben, irgendwo in der Range zwischen 0,25 und 0,5%. Und wir hatten 3 Mitglieder in diesem Komitee, die gesagt haben, zwischen 0,5 und 0,75%. Jetzt, heute, ein komplett anderes Bild, wie ihr seht. Wir haben niemanden mehr in diesem Komitee, der noch glaubt, dass die Leitzinsen auf dem aktuellen Niveau bleiben. Wir haben eine Person, einen letzten Kämpfer, der sagt, nein, die Leitzinsen bleiben relativ niedrig bei 0,25 bis 0,5. Wir haben 1, 2, 3, 5 Mitglieder, die sagen zwischen 0,5 und 0,75. Und wir haben plötzlich den Großteil des Komitees. Und das ist wirklich hier eine massive Veränderung. Ein Großteil des Komitees hat hier radikal die Meinung geändert und sagt, im Jahr 2022 werden wir zwischen 0,75 und 1% liegen. Und 2 Mitglieder sagen sogar darüber, nämlich zwischen 1,0 und 1,25. Das ist die massivste Veränderung. Und jetzt müsste man nochmal vergleichen, was für 2023, 2024 entsprechend vorher gegolten hat. Das werde ich euch jetzt nicht nochmal antun hier im Livestream. Der Markt reagiert positiv. Jetzt fragt ihr euch, warum reagiert der Markt positiv, wenn doch Leitzinserhöhungen so giftig sind? Nun ja, diese 2 bis 3 Leitzinserhöhungen, die waren natürlich längst vom Markt eingepreist. Das war ja dieser Schmerz im Markt, den wir in den letzten Wochen gesehen haben. Das war der Versuch des Marktes, eben genau das einzupreisen. Und jetzt kommt also die Veröffentlichung der Fed, die genau das bestätigt, dass die Prognose des Marktes stimmt und die Einpreisung korrekt war. Und was dann natürlich passiert ist, so wie wir es oft haben, wenn zum Beispiel Unternehmen Quartalsberichte veröffentlichen, dass wir sozusagen in der Erwartung, die Aktie steigt und dann bei Veröffentlichung der Quartalszahlen die Aktie plötzlich fällt. Hier haben wir sozusagen genau den gegenteiligen Effekt, sozusagen sell the rumor, buy the news. Verkaufe das Gerücht, kaufe die News. Also ihr seht, es ist durchaus verrückt, wie der Markt so tickt und wie der Markt so funktioniert. Leichte Rücksetzer jetzt wieder bei Tesla. Die Euphorie lässt hier etwas nach. $952. Was haben wir sonst noch? SoFi, mal gucken, was SoFi macht. Gucken, was Apple macht. Apple ist auch stark dabei, $175. Bitcoin wieder auf dem Weg zur $50.000 Marke hier. Was haben wir hier noch? AMD plus 2,25%. Lemonade plus 3%. C3 AI war schon den ganzen Tag extrem stark unterwegs, aktuell plus 8,3% bei C3. Ansonsten haben wir hier Peloton aktuell minus 4,5, Pfizer plus 4, Cloudflare plus 4, Facebook knapp 0,5% plus. Wir haben Adobe leicht im Minus, aber hier auch eine Rallye in den letzten Minuten. Wir haben Zoom minus 1,2%. Fuel Cell plus 1%. Enphase minus 0,9%. SPY, also der S&P, jetzt auch ins Plus gedreht mit 0,35. Wir hören nochmal, was Bloomberg zu diesem ganzen Theater zu sagen hat.
That's why we see stocks kind of having a relief rally and then the bond market really having a muted response. But, I think Diane made some really excellent points. And I liked her comment about the high wire act that the Fed is on, because when you look at the data, you look at the shape of the yield curve, you hear the abrupt shift in rhetoric around inflation being transitory, and we see the dot plot with a very strong path of rate increases. I think that the market has not been priced for the worst case scenario, and based upon just the shape of the yield curve, for instance, which the Fed chose to ignore. Let's remember, they chose to ignore this prior to the last recession, that we are now setting ourselves up for recession in 2023.
Last time around, of course, no one could have forecast what happened with the pandemic, Scott, but I'm with you. They certainly weren't worried about what was happening with the yield curve going into all of that. 2's 10s right now at 76. Scott, before we compare the front end to the long end, let's just sit on 10s for a moment. 146, and I keep going back to this, Scott. At the start of the year, have I said to you, this is where inflation will be to end the year. This is where growth will be to end the year. Would you have guessed the 10-year would be at 146, Scott?
Well, Jonathan, I hate to say this, but I'm probably one of the few people that would have. When I've looked back in history, and I'm heavily affected by history, when you look at the 1940s, for instance, we had a period of inflation, which I'm going to use the air quotes here of transitory, that lasted between 1946 and 1949. Interest rates peaked in I think it was in 1947, around 2.5%, and inflation peaked at 20%. So, given this policy of financial repression, I've been expecting interest rates to stay well below the rate of inflation. The only thing I would say, Jonathan, that's caught me a bit off guard is how strong the inflation's been. But, still even at 7%, we're nowhere near where the Fed was back in the 40s at 20%.
Scott, quantify the recession you just called for in 2023. On an inflation dynamic and a real GDP dynamic, how do you get there?
Well, I think, Tom, one of the things our work shows is that the terminal rate, really, given the debt load on the economy, is probably somewhere in the neighborhood of 1.75%.
Also für alle, die gerade eben das eingeschaltet haben, das Ergebnis der FOMC-Sitzung wurde bekannt gegeben. Wir hatten ja vorher diskutiert, Taube oder Falke, Tapering. Erwartet hatte der Markt 30 Milliarden und Leitzinserhebungen 3 Stück. Und das Ergebnis ist genau das, was der Markt erwartet hatte, nämlich die 30 Milliarden Tapering. Das heißt, die Anleihekäufe werden stärker zurückgefahren, jetzt um 30 Milliarden pro Monat. Das heißt dann auch, dass das Tapering früher endet, nämlich bereits im Mai, glaube ich, sodass dann eben im Juni, Juli der Weg frei wäre für die ersten Leitzinserhöhungen. Und es gibt aber auch immer noch das Szenario, und das will ich auch ganz klar sagen, dass diese Leitzinserhöhungen, die aktuell vom Markt eingepreist wurden, am Ende dann gar nicht stattfinden. Denn wenn wir zum Beispiel ein Szenario bekommen, in dem die Inflation gar nicht so heiß läuft, wie viele vermuten, zum Beispiel, weil auf einmal sehr viele Schiffscontainer, die aktuell noch in den Lieferketten festhängen, plötzlich bei den Unternehmen ankommen und die Unternehmen plötzlich auf einem riesigen Lagerbestand sitzen und gleichzeitig die Konsumlaune der Menschen zurückgeht. Ihr müsst euch ja vorstellen, aktuell sind wir in einer Phase, wo die ganze Welt aus einem Lockdown kommt, wo wir jahrelang zu Hause rumsaßen und jetzt plötzlich in großen Teilen der Welt jedenfalls erstmals wieder frei sind. Und die Leute geben ihr Geld links und rechts aus. Gleichzeitig gibt es aber ein sehr knappes Angebot durch diese Lieferengpässe. Und wenn wir jetzt also im Q1 22 oder im Q2 22, habe ich 21 gesagt? 22 meinte ich, 2022. Also im Q1 22 oder Q2 22. Wenn wir da in ein Szenario reinkommen, wo sich das komplett umdreht, wo also die Konsumlaune der Menschen zurückgeht, zum Beispiel, weil diese Effekte dieser Euphorie aus der Pandemie rauszukommen langsam abklingen und die Ersparnisse der Privathaushalte natürlich auch zurückgehen. Ich meine, die Leute haben nicht unendlich viel Kapital, um das auszugeben. Heißt, die Konsumlaune auf der einen Seite geht zurück, auf der anderen Seite steigen aber auf einmal enorm die Warenbestände bei den Unternehmen. Und dann kommen wir eben in eine Situation, die genau das Gegenteil von dem ist, was wir gerade erleben. Und das sind dann plötzlich deflationäre Effekte. Das heißt, die Unternehmen müssen die Preise senken, um diese Waren überhaupt noch loszuwerden. Und ich bin ein Anhänger dieser Theorie und glaube, dass wir also im nächsten Jahr deflationäre Effekte sehen könnten. Und in einem solchen Szenario wäre es quasi Selbstmord von der US-Notenbank, in einem solchen Szenario dann auch noch die Leitzinsen zu erhöhen. Das bedeutet, ich halte es für relativ wahrscheinlich, dass der Markt aktuell zwar diese Leitzinserhöhungen einpreist, nämlich 3 Stück, dass wir aber zunehmend in ein Szenario reinlaufen, wo das letztendlich gar nicht stattfindet. Und das wird aus meiner Sicht der Auslöser der nächsten Rallye in Tech- und Wachstumswerten und in Small- und Mid-Cap-Aktien sein. Weil dann natürlich auf einmal klar wird, verdammt, wir haben hier Leitzinserhöhungen eingepreist, die jetzt gar nicht stattfinden. Und das wird eine wirklich, wenn es so passiert, und es gibt natürlich Risiken in dieser Theorie, das will ich ganz klar sagen, aber wenn es so passiert, wird das ein Startschuss sein für eine Rallye, die wir seit langer Zeit so nicht mehr gesehen haben. Das ist meine Theorie und das ist der Grund, warum ich in diesem Markt investiert bleibe. Risiken. Was könnte passieren, dass diese Theorie auseinanderbröselt? Beispiel wäre Omikron. Ja, sollte sich zum Beispiel diese neue Virusvariante doch als problematischer herausstellen, als viele derzeit vermuten, dann ist das natürlich ein Problem insofern, dass diese Lieferengpässe sich nicht auflösen, dass die Probleme an den Häfen sich nicht auflösen und dass die Unternehmen am Ende eben doch nicht diese großen Lagerbestände haben und dann eben nicht in die Situation kommen, wo sie Preise senken müssen. Ein anderes Risiko ist sicherlich, dass ja Inflation auch ein psychologisches Phänomen ist. Wenn man jetzt sich gerade Umfragen anschaut in den USA, dann werdet ihr feststellen, dass vom ganz normalen Otto-Normalverbraucher Inflation gerade als Risiko Nummer 1 für das nächste Jahr gesehen wird. Also es ist nicht mehr so, dass Inflation jetzt nur noch von Börsenexperten oder Leuten, die sich generell für das Thema interessieren, so wie wir alle in diesem Livestream, besprochen wird, sondern das Thema Inflation ist gerade an jedem Frühstückstisch in den USA ein Thema. Das wird in den Medien rauf und runter gespielt. Das wird auf Social Media aufgeblasen wie sonst was. Und das Problem mit Inflation ist ja, dass allein der Glaube an Inflation mehr Inflation erschaffen kann. Denn wenn ich glaube, dass morgen und übermorgen die Preise immer weiter steigen, was mache ich dann? Ich renne ins Geschäft, ich renne in den Laden und kaufe mir den Fernseher heute, kaufe mir die Waschmaschine, kaufe mir das Auto heute, weil morgen steigen ja die Preise. Das heißt, allein aus dem Glauben heraus, dass die Inflation kommt, erschafft die Bevölkerung Inflation. Und das ist eben etwas, was sehr schwer vorherzusagen ist und wo die Medien natürlich auch eine unglaublich wichtige Rolle spielen. Und wo natürlich auch die Kommunikation der Notenbank eine Rolle spielt. Weil wenn die Notenbank eben zu sehr taube ist und zu wenig Falke ist, dann verstärkt das ja den Effekt in der Bevölkerung, dass man sagt, oh, die Notenbank, die lässt das einfach so schleifen, die kümmert sich nicht um die Inflation und diese irrationalen Ängste vor der Hyperinflation werden immer stärker und das ist einfach eine selbsterfüllende Prophezeiung. Und das sehe ich nach wie vor als sehr großes Risiko, ehrlich gesagt. Und Unterm Strich würde ich dennoch sagen, dass ich dieses erste Szenario weiterhin für sehr viel wahrscheinlicher halte. Dass wir also weniger Inflation bekommen, dass keine 3 Leitzinserhöhungen stattfinden und dass das eben dann die nächste Rallye im Markt auslösen könnte. So, wir schauen mal Palantir. Palantir jetzt bei 18,55, minus 0,5% heute. Tesla 952. Ja, das Momentum lässt gerade ein bisschen nach.
Slow down the pace of money growth. Let's not abruptly stop
Und in ungefähr 8 Minuten kommt dann der Chef der US-Notenbank, Jerome Powell, vor die Kameras und wird noch ein paar weitere Details zu den Ansichten der Notenbank geben. Und das wird natürlich auch von den Anlegern mit Spannung erwartet, weil der US-Notenbankchef oft ein bisschen anders tickt von seiner Kommunikationsweise, als das aus diesen Papieren eben hervorgeht. Insofern wird der Markt da nochmal sehr genau hinschauen gleich. In 7 Minuten geht's los.
in a way that they wouldn't want to react.
Lisa, we've been talking about the durability of that Fed put going into next year and the question mark over it because of this inflationary backdrop.
And not only the Fed put in the near term, but also based on what Scott Meinert is talking about, what happens when the market does sell off? What happens in a recession? John, what does a Fed put look like in a recessionary environment where their balance sheet is already bloated and they haven't had time to run it off?
Well, right now, this equity market's very close to an all-time high at 46.50, up a third of 1%. Diane, let's play the Chairman Powell question game for the news conference. Not that Mike McKee needs any help, but if you had a question for him today, Diane, what would it be?
Oh, gosh, the number one question is, did you discuss when a tapering of the actual balance sheet, a shrinking of the actual balance sheet, and when that would begin and how you'd sequence it with rate hikes? That is the number one question out there. Are we going to get an amplified rate hike with the balance sheet shrinking at the same time that rates are hiking, or will it be more like the end of 2015 where the balance sheet continued to sort of stayed stable and actually continued to rise at that point in time before they got to the point of actually being willing to allow the balance sheet to shrink? We know they're going to stop the balance sheet by March now, that it won't be growing anymore. The question is, how rapidly do they allow that balance sheet to shrink, and how do they use that to amplify rate hikes this year, those 3 rate hikes they're expecting this year, and on top of it, what we see next year. And I think that's where all the money is right now. And I do want to add, Chairman Powell has not had the hubris of previous chairmen in the Fed's ability to forecast. He is willing to pivot. Yep. I agree full-heartedly with Scott on that. This is something he's got humility about the Fed's ability to forecast. He will de-emphasize the dot plot. These were all done before they walked into the meeting, before the retail sales data came out. He will emphasize that as well, and it will fall on deaf ears.
Can we get Diane Swonk a seat at the news conference, Tom?
I was going to get her a seat at the governor's table.
That would help too.
You know, I mean,
maybe
Governor
we can talk about
Swank has a ring
There's still some seats there, TK, ready to go.
Scott could endow the chair, the Governor Swank chair.
I think Scott would be a troublemaker on the FOMC, Tom. Diane Swank, Scott Meinert, thank you to you both. Absolutely brilliant. Lisa, some questions on balance sheet reduction. It's a big, big push by a lot of people in this market. They want to understand where it fits in the sequencing.
And frankly, to understand what effect it's had on the market. I mean, we were just hearing about how the yield curve is potentially a distorted measure for a number of people who say that it's been highly influenced by the balance sheet expanding as it has. We don't really know. Honestly, I've talked to other people who say we're still in secular stagnation. So at what point does the Fed use a tool that it doesn't fully understand?
As we inch closer to this news conference, about 4 or 5 minutes away at the front end of the yield curve, yields are higher by 4 basis points. They're just short of 70. Your equity market pop fades a bit. Positive 0.2% on the S&P. Breaking down some single names. Let's get to Romain. Hey, Romain.
The pop fading just a little bit, but you talk about that repositioning that we saw leading up to today. Of course, it was that flight out of tech, a lot of the high multiple tech. You're seeing a slight flight back into that, but it's not necessarily broad-based when it comes to tech. You see the spike here in Apple. It's basically the companies, the big cap tech companies that can stand on their own without that sort of invisible hand of the Fed behind them. That seems to be at least what the knee-jerk reaction is here within the last 26 minutes. Flip up the board. A lot of people thought we would actually see a big pop in some of the materials names. The idea here that even with a more hawkish Fed, that the economic picture was still intact. A lot of folks not necessarily betting on that again. This is a knee-jerk reaction. A lot of this could change once we hear Jay Powell, Freeport-McMoran, the big copper miner, down about 4% right now. You're seeing a lot of the other names in this space, like Nucor, also lower here on the day. In fact, Nucor, your biggest decliner in the S&P 500. And finally, let's take a look at the banks, because this is basically what the moment that a lot of folks in the banking space had been looking for, that idea that we would start to see some sort of rate normalization, or at least policy normalization, that lift off in rates that could maybe underpin a little bit of a bid into the banking sector. Saw some of that bid come in prior to today, but nothing really happening right now. You're taking a look at Bank of America, representative of what's going on broadly in that space, down about 1 percentage point.
Romain, great work as always, buddy. Looking forward to the coverage going into the close a little bit later on Bloomberg TV and on Bloomberg Radio. Reaction to that Fed decision to double the taper, to introduce a dot plot that signals 3 hikes next year, 3 hikes the year after that. Mohammed Al-Arian out on Twitter, very critical of this Federal Reserve recently, Lisa, saying the following: a notable shift in Fed policy that's slightly more hawkish than consensus expectations, though somewhat less than what I think is needed. The doubling of the taper comes with an increase in the inflation forecast and more aggressive signaling of rate hikes. The press conference is key. That news conference a couple of minutes away.
That last point really important, given how different the notes of the last meeting were from the rhetoric that we heard out of Fed Chair Jay Powell. Also interesting, given the split forecast at the last meeting, this was unanimous. They're somehow always unanimous on the same page about even a huge pivot, and that to me is notable. When do we see some sort of leadership change or disagreement under the surface start to percolate out?
We've got a shift, TK. Mohammed says it's probably not enough.
Well, it's a shift, John, and I'm going to go to the press conference. I think it's going to be incredibly important how he finesses this. Again, I want to suggest, and this goes to the observation on no dissents, that this is a Fed that understands its institutional power, even in a crisis like this. And it's not that they're all on the same page, but they're all singing from the same prayer book as they go to the pressure the chairman will face here in 1 minute.
The problem, as always, on decision day for the Federal Reserve, Lisa, it's that gap between the decision, the statement, the summary of economic projections, and then the news conference where things can always change. And this equity market, let's be clear, is all over the place. The Nasdaq was positive for a moment, now negative 0.2%.
So let's play the guessing game. What they could say that could potentially move markets dramatically, anything having to do with the balance sheet. If they talked about allowing the balance sheet to roll off, or anything in the near term, that could have a dramatic effect. Also dramatic would be if somehow they did indicate to Posner's point, Adam Posner, that they were looking to that they were potentially looking to keep inflation at a higher rate going forward on a persistent basis.
It can always go 2 different ways. Balance sheet reduction, if you want to make it more hawkish, introduce that conversation. Lisa, if you want to make it more dovish, increase the flexibility, de-emphasize the dot plot. The chairman's done it before. I've got no idea if we'll do it again, but that's going to be a focus for everybody. Going into this one, about 30 seconds away, let's try and get up to speed with this equity market, shall we?
Good luck with that.
Thank you, Tom. All over the place on the S&P 500. Was negative, now positive. Was about to turn negative, now positive, 0.1% on the S&P 500. In the bond market, it's been fascinating, but we're still struggling to sustainably break 70 basis points. We're just short of that right now on 2s. On 10s, Tom, at 146.16.
Joe Weisenthal just tweeted out in this, John, you're dead on. The bond market, the non-news from the bond market is the news today.
Here is your chairman of the Federal Reserve.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continued to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer-run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Mr. Chair, we'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment, and there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So, as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment, and you see that in, of course, in some of the factors that I mentioned.
Great, thank you, Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it. And we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do,
Oops. Sorry, verklickt.
But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But that's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
Wie viel Abstand,
So
zeitlicher Abstand zwischen
we haven't
Ende des Taperings
made any
und
decision of that
Leistungsende?
nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short?
Normal Live fragt im Chat, ob ich auch trade. Ich trade sehr selten. Ich bin kein Daytrader. Ich mache ab und zu mal kurzfristige Wetten, wie zum Beispiel habe ich Rivian geschortet vor einigen Wochen. Oder ich mache ab und zu kurzfristige Spekulationen mit Hilfe von Optionen, Call-Optionen oder Put-Optionen. Aber ich bin zu 90% Investor und kein Trader. So würde ich es jedenfalls ausdrücken.
Related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report. But I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in. But really, it's the pandemic. It's a range of factors. But the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now. And inflation is well above target, so this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. on top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated, so people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the Employment Compensation Index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report, and revisions to prior readings, and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see. Wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation? And how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly, and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at. And it's so I mentioned a number of the things. You could get to 20 if you wanted to. Easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. Let's say we knew that it would start to move up in 2 years, would we wait 2 years, or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year, and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at labor market conditions consistent with.
Sorry, beim nächsten Kommentar werde ich Jerome Powell stumm schalten.
Over time, that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation, and also whether running the economy hot, like in the last expansion, is one way of doing that?
Well, the labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That really, why is it low is the question. So there are a bunch of answers, and all of them probably have some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of child care for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one-income rather than a two-income family. The same thing with people's houses. People they have a mortgage, and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they're, they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. Really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks. Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, though, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Ethereum 4000. Los geht's.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased, and I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk, and I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months, but we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, The Wall Street Journal.
Yeah, thank you for taking my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but, what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more a four-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are four key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated, and right now they aren't, and they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist, and you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks, and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you.
I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, yeah, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that, obviously, in coming meetings. I don't think the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff.
In the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence of that we have to put up with because of that?
No, I'm not expressing any judgment about the stimulus in that comment. What I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because no one had seen what 3.5% unemployment would look like with high labor force participation. By the way, no one had seen what it would really look like for an extended period for decades. And we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So this so far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once-in-a-lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes, and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end, and it makes sense that it's reacting to changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think, there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy, rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We wound up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Letzte Frage.
Thank you very much.
Hoffentlich eine gute Frage.
Chair Powell, I was wondering if wanted to give you the opportunity to talk about something I've heard that's been discussed, that your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Ooh. Thank you.
Sure, I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting, and then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two. And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all. And I just thought, this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
just a quick follow-up. I guess that some people are saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all, and the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Chairman Powell wrapping up that news conference from New York City on TV and on radio.
Wow, okay. Wir sind durch mit der Pressekonferenz. Respekt, dass so viele von euch durchgehalten haben, obwohl es recht trocken wurde zum Schluss. Ich hoffe, die kleine Zusammenfassung hier hat euch geholfen, ein bisschen besser zu verstehen, wo die Fed steht und wie die Fed denkt. Ich habe auch den Link nochmal in die Telegram-Gruppe reingepostet, falls ihr das nochmal nachlesen wollt. Die Interpretation des Marktes ist auf jeden Fall, so kann man sagen, deutlich positiv. Wenn man hier auf die Karte des S&P 500 schaut, dann sehen wir ganz klar, dass gerade wieder in Tech reinrotiert wird. Wir sehen hier sehr, sehr, sehr viel Grün im gesamten Technologiesektor, im Kommunikationssektor und auch im Consumer Cyclical, also Amazon, Tesla. Und diese Aktien sind alle grün und es wird hier unten aus den Banken raus rotiert. Ihr seht hier, JP Morgan hat verloren und Wells Fargo und diese ganzen großen Player aus dem Bankensektor, die ja von, ich sag mal, Inflationsängsten eher profitieren, die zum Beispiel gestern sehr stark grün waren. Die sind jetzt rot. Das heißt, meine These ist, dass hier sozusagen aus Banken raus in Technologie rein rotiert wird. Mal schauen, wie die letzte halbe Stunde des Marktes verläuft. Das werden wir nicht mehr im Livestream verfolgen, aber kommt gerne in die Telegram-Gruppe, um mit 1800 Mitgliedern über den Markt zu diskutieren. Den Link zum Beitritt findet ihr unter diesem Video. Sehr spannender Tag. Wir sehen uns im nächsten Video. Bis dann. Ciao.